absolute busy diary. So without further ado, Henk, let me first hand across to yourself, please. And I'll let you take the virtual stage. Thank you.
Hi, good morning, Andrew. Good morning, everyone. It's a pleasure to be with you. Unfortunately, we have a few technical issues, which means you can't see my video, which may actually be a benefit for you this morning, but hopefully you can hear me nice and clear. So give them around about 15 minutes, as Andrew said, so I thought I'd discuss the outlook of the global economy and focus on three major areas. Number one, of course, the impact of the coronavirus on the global economy, the policy response that we've been seeing. Then we'll go on to look at the UK economy. Where are we? What can we expect from the banking? And of course, touch on Brexit, which has been, of course, pushed to the background a little bit as a result of the coronavirus, but those negotiations continue. And finally, we'll consider what the post-COVID-19 world looks like. Starting with the global economy, where the lockdown, as we know, has thrown the global economy into recession. The pandemic has resulted in millions of infections, hundreds of thousands of deaths around the world. The scale of the outbreak has placed enormous pressures we've been seeing on national health services. Governments have been forced to impose aggressive measures, including social distancing, self-isolation and restriction on travel, all in an effort to contain the spread of the disease. Locking down of economies has resulted in an unprecedented drop in economic activity, surging unemployment, permanent losses in output, and temporarily slower potential growth. As a result of the disruption, we now expect the global economy to contract by somewhere around 3.7% during the course of this year. Now, to put that in some sort of context, the scale of the change that we've been seeing as a result of the disease at the start of the year, we are forecasting growth of around 3.3% for this year. The scale of the risk to the global economy has, as we know, encouraged central banks to slash interest rates, to inject huge amounts of liquidity into the financial system. Governments have embarked upon an extraordinary fiscal response, including allowing companies to furlough staff, as well as pledging vast sums in loans, grants and credit guarantees. We have to say the reality is future growth prospects will inevitably be determined by the lifespan, the intensity and the geographical spread of the virus. However, a controlled lifting of restrictions should help to alleviate some of the economic pressure. Although activity we're seeing playing out in the United States, but in Melbourne and other cities, will continue to be vulnerable to the development of a second wave. And a true normalisation of activity will only occur when a vaccine has been developed. I think given the time required to develop, test and distribute a vaccine, it's unlikely to be widely available in the next 12 to 18 months. But with a tentative reopening of economies, the vast level of stimulus indicated by policymakers, we are projecting a recovery into the second half this year and into 2021. We've got global growth forecasted to be 5.2% as you look through next year. However, certain sectors, pretty much the obvious ones, but airlines, hospitality, non-food retail, may take many years to recover. We also think there's going to be permanent changes to working patterns, supply chains, and global trade as a result. Moving on to the UK economy, no surprise, the pandemic, of course, has disrupted the UK economy, country facing the highest number of deaths in Europe, although you can, of course, debate how these numbers are calculated, but putting that to one side, it's certainly been a difficult time for the UK economy. First quarter GDP fell by 2.2%. Remember, that only contains a few days of lockdown. The second quarter, when we get the official numbers through, is likely to be much, much worse. April retail sales volumes, for example, month-on-month basis fell 18.1%, the worst that we've seen on record. So in terms of our forecast for the second quarter, we're looking at a contraction somewhere around 17%. Again, to put that in some sort of context for you, that's the worst that we've seen in 3 centuries. Quite incredible, although we should remind ourselves it's an awful lot better than was feared just a couple of months ago. The UK data has actually been showing signs of improving over the course of the past few weeks. Activity is rebounding as the economy reopens. If you look at mobility indicators, they've shown a pickup in public transport indicators and driving activity. Electrical power load usage has rapidly recovered from the April lows. There's also signs that households are willing to normalise their spending patterns fairly quickly. So footfall levels in stores have been rising. Sales volumes in May rebounded. That jumped a record 12%, although still down around about 13% compared to where they were a year ago. Looking at UK inflation, well, UK inflation fell to a 4-year low in May, Consumer prices rose just 0.5% from a year earlier last month. That's amid weaker demand, falling fuel prices, weakness in transport, recreation and culture goods. We've only seen a modest upward pressure coming from food and non-alcoholic beverage prices. In terms of the outlook for inflation, CPI inflation is expected to fall slightly further in the near term. The drag from COVID-related shocks continue to build. It's then expected to rise, I think, during the course of 2021. The direct impact of the recent fall in the oil price drops out of the annual comparison, and the downward pressure from domestic factors wanes as demand starts to recover. So to give you the headline numbers, as we look through this year into 2021, look for a full year contraction of 7.5% this year. 2021, as we said, should be supported by significant fiscal stimulus and monetary easing. We look for growth of 5.8% for the UK economy. Looking at the Bank of England, we've seen an aggressive response from the central bank. Bank of England cut rates to a record low of 0.1%, as we know. They've increased the size of their bond buying programme by £100 billion. That total now stands at an astounding £745 billion. But they did slow the pace of purchases sharply, saying high-frequency data pointing to a faster recovery, and also reacting to the stabilisation of financial markets as well. They said they plan to stretch the programme out until the end of the year, which you have to say is still an aggressive timetable by any standard. What are they hoping to achieve through quantitative easing? Will boost economic activity and reflate the economy. Large-scale purchases of government bonds lower the interest rates or yields on those bonds, thus pushing down the interest rates offered on loans, that's business loans as well as mortgages. Cheaper borrowing should therefore encourage spending. To also remember, quantitative easing boosts asset prices. It drives the wealth effect, and that can lead to an increase in spending as well. There are some unintended consequences of quantitative easing. Puts pressure on investment strategies that rely on long-term interest rates for return, particularly pension funds, encourage investors to take on more risk to get a return. Inflating asset prices also generates further income inequality. No doubt the Bank of England will be watching for signs of that. In terms of negative interest rates, there are lots of headlines around this from the Bank of England. The governor at the most recent meeting said taking borrowing costs below zero was complex and not in any way imminent. Negative interest rates, mind is where the central bank charges retail banks on its deposits of excess reserves with the central bank instead of normally paying an interest rate. The theory being it makes it expensive for banks to sit on those reserves, forcing them to lend the money, thereby stimulating growth and reflating the economy. Does it work? Well, you could argue even the threat of negative rates pushes down borrowing costs lower. Britain sold a bond recently with a yield below 0% for the first time. So, in fact, simply threatening it can be as productive as actually implementing it. Implementing it creates, again, some unintended consequences, cause havoc, as we know, in the banking system, leads to declines in net interest margins. Europe is a very good example of that. Discourages companies from holding adequate buffers against financial stress. Encourages individuals and businesses to take on more debt, which may not be sustainable in the long term. Can create asset bubbles, but also creates zombie companies that are detrimental to the long-term development of economies. For us, I think we would need to see a massive deterioration in UK growth prospects for the Bank of England to consider such a move. I think policymakers are likely to remain focused on this coordinated monetary and fiscal approach that we've been seeing. Measures that enhance liquidity, address dysfunctional markets, boost confidence and stimulate demand. It's pretty much where we see the focus for the Bank of England. Quickly touching on Brexit, Boris Johnson's Conservatives came into power in December, of course, pledging to get Brexit done. Britain officially left the European Union on the 31st of January, formally entering this period of transition. However, the fourth and final round of official talks on the future trading relationship between the UK and the European concluded recently with very little progress, although there have been pledges to pick up the intensity of negotiations to try and get a deal done. Key sticking points continue to be the level playing field commitment. The UK continues to reject EU demands for a level playing field, which would see the UK aligned with the European standards in areas such as the environment and workers' rights. There's also disagreement over the governance and the form of the agreement, along with the sovereignty over UK fishing waters, financial services equivalents, the role of the European Convention on Human Rights, and of course the Northern Ireland Protocol, which is a complicated arrangement which aims to avoid a hard border on the island of Ireland. So where are we today? Well, recent briefings have suggested a compromise could still be reached, whereby Britain deviates from the level playing field. Europe at that point could impose additional tariffs. Thus would allow both sides to claim a victory. But I think realistically, we can expect little progress in the negotiations until near the end of October, with each side holding off as long as possible before moving on those positions. The Bank of England has warned banks to prepare for a no-deal Brexit. The impact of a no-deal Brexit on businesses would be significant, of course. You're talking about trade barriers, talent pool restrictions, regulatory restrictions, changes in taxation. So for businesses, what does a no-deal Brexit mean? Increased cost, increased complexity, perhaps fundamental changes to their business model. Although you could argue fears of a no-deal Brexit may prove to be less dramatic than the lead up to previous deadlines. Remember, companies have now had 4 years to prepare. Policymakers have promised unlimited support. And you could argue that businesses would finally welcome some much needed clarity. And there are some signs that trade agreements with other countries have been gaining some early momentum, although we should continue to remember that Europe is and will continue to be the UK's most important trading partner. Let me very quickly finish off with how we see the post-COVID world. Past the worst, does not mean out of the woods, nor back to normal. COVID-19 crisis, we think, will have implications for society, economy and financial markets over the long run. More debt, fiscal deficits and public debts have been skyrocketing, as has corporate leverage. More inflation, less globalization. I think COVID-19 accelerates deglobalization. It started with the trade war, could prompt governments to promote self-sufficiency in strategic areas, particularly like food, healthcare and defense. Technology, of course, has been an important component of all our lives, more important than ever before over the course of the past few months. It's played a big part in keeping the economy afloat when the world went into lockdown. So more working from home, more virtual meetings like we're doing today, less business travel, less office space needed. The crisis, we think, accelerates the digitalization of the economy. More healthcare, I think, is going to be important as well. Crisis reinforces the trend towards more healthcare spending by governments and more universal coverage. I think that's both in the developed and emerging economies. Research budgets could be boosted, as well as spending on infrastructure and equipment. A different type of consumer as well, as we've been talking about. Real shift in terms of spending patterns and consumer behaviour as social distancing rules, working from home and digitalisation forms a change in consumer demand, and retailers will have to adapt to that. So there's some of the major changes that we've been talking about as a result of COVID-19. We don't think we'll go back to the normal world as we knew it before the pandemic. We think the global economy does recover. We know that authorities have been very aggressive in terms of that stimulus. We think that will inevitably shine through, but we need to watch the path of the pandemic very carefully indeed, because that will determine where we go before a vaccine is fully developed and distributed. So that's our view in terms of the global economy, particularly look at the UK. Let me now hand back to Andrew to move on to the other panellists.
Thank you very much indeed, Hayden, because you quickly galloped through a whole range of topics that you could spend 15 minutes on each, let alone 15 minutes seeking to get an insight on all of those. So let me please now hand across to Miles. Over to you, good self, please, Miles.
Well, thank you very much, Andrew. Thank you very much for inviting me here today to represent HSBC. Andrew, would you mind just turning your mic? Sorry, just one moment while we arrange the technical side. Maybe I can do it. There we go. I think I'm in the driving seat. So thank you very much, Andrew. And as I said, delighted to be here on behalf of HSBC. So today we're covering, we're covering the navigating of business continuity. And from my perspective, I head up HSBC's business banking division here in the UAE, and that's the area covering SMEs. So in terms of what an SME means for me in this market, I deal with the UAE managed, owned and managed businesses. And in terms of thresholds, turnover thresholds, we're dealing with businesses up to 250 million dirhams. So predominantly it's in the 30 to 250 million dirham turnover space that I operate. With regard to sectors that we see, I think the predominant sectors that operate are largely across manufacturing, construction, subcontracting, wholesale, import, export. And with that, we do see quite a lot of oil and gas focus. So again, when I'm looking at this space, they're the kind of sectors that we're dealing with on a day-to-day basis. In terms of this presentation, I will, towards the end, talk around other sectors as well, and we see a number of key sectors expanding, and I think a couple of those were mentioned by Henk in his presentation as well. So with regards to HSBC, we're proud to operate in this space as an international bank operating with SMEs. And we do have obviously a strong link with the UK, hence our close involvement with the BBG. And I'm very pleased to say that out of our client base, if we look at the owners or the key decision makers within our client base, there's a strong percentage that are British, have British nationality, a good 20% plus. So the links between the UAE and the UK, are really strong for us, and help us to operate going forward. So with regards to kind of how I want to cover it today, I'm going to talk through three broad headings, and that's in terms of how businesses, the SMEs in the UAE, have been dealing with the current situation over the last few months. So those headings are under the headings of react, recover, and rebuild. And I think if we all look at our own businesses, whether it's we're managing divisions of banks or whether we're entrepreneurs on the line, I think we can identify how we've each gone through or are going through each of those three stages. And from my perspective, I've been able to link in with the SME heads within HSBC from around the world, and that's been really insightful as they've talked through their journeys, and we kind of plot where everyone is on that schedule. So, for example, I've linked closely with China and Asia, who were 10 weeks, 12 weeks ahead of us on this, and I think when we went into it, it was really encouraging to speak to them when they were in the kind of the recover rebuild stage, whilst we were still in the react stage. So I think when we look at businesses, look at stages, they're the ones we're going through, and I think it'd be interesting if you could maybe identify where you sit on that spectrum. So if we start off with react. I think if we think back to when things were happening very quickly, there was certainly a real clamor for news and information. So as businesses and everyone were trying to understand how the pandemic was evolving, how it was affecting people. And I think there was a real boost in information that was out there, and the number of webinars increased, and we're on today, and I think many have occurred. It's also been really important to understand the laws and the rules, and those have evolved pretty quickly. So I think we've had lockdowns here in the UAE, and it's just understanding how we can operate within those and how that affects business operations and business continuity. And we're still seeing some change in laws and rules around travel as well, and that at the moment is becoming a big topic for conversation. Also as well, through the react stage, all of us in business have had a real focus on people. I think that the actual health and well-being of our teams, of our clients, of their teams has been really important, and we need to make sure that we understand that, and we can remain compassionate and kind of advise businesses on that as well going forward. I think we've also, through the react stage, and have seen a real boost in communication and technology, and I'll talk to technology a bit as we move through this, and we look at different areas that we need to invest in. So before 3 or 4 months ago, I didn't have a Zoom account. Now I'm operating daily on Zoom, and I think there's some real steps forward in terms of how to communicate. And so that's an area that everyone will do quickly. And I think with regards to that digital adoption as well, we've seen a real uptake in in businesses migrating a lot of their systems, a lot of their processes online. Now, I can look at this through the lens of online banking take-up. And we, in the UAE, there is a good level of digital engagement in the financial sector. But we've seen a significant push when we're towards 100% of our clients engaging with us online, and that has seen a significant upstep, and and I think our sector will continue to see that going forward. I think through the React stage as well, and I think this is important when we're talking to all our clients, as well as those key issues that have been going on. One of the key concerns around for businesses have been their cash flow requirements. And that's required myself and my team to be making sure we're communicating almost daily or weekly with our clients, just to really understand and help them understand what their immediate cash position is. So it was a very much focus on receivables in versus receivables out, operations, ability to bill, and I think that's been a real concern for businesses. So liquidity and access to cash was key earlier on. Within the UAE, we've had the banks have all benefited from the launch of TESS, the Targeted Economic Support Scheme from the central bank, and that has been a fantastic tool for us as bankers to speak to our clients who have facilities with us and really constructively understand what their cash flows look like, what their repayment requirements are, and to put debt repayment postponement in place on a really, on a very good basis and on a bespoke basis for each client. And I think that tool is one that has allowed businesses just to pause, to get closer to their receivables, to understand their cash flows, and just make sure that they've got that time to reorganize, to look at their underlying business as they move forward. So, a key scheme that we've all been party to. So I think as we move through the React stage, we kind of clearly move on to recovery. And I think in terms of the broad client base that I speak to, I feel that the economy, or the SME economy, is very much in the recovery stage at the moment. I think everyone has reacted to the situation, has adapted, and so forth as needs be. But we're now in the period of kind of medium-term view, looking at planning and strategy and so forth. So I think a lot of our conversations have evolved with customers to really talk about that longer term. Businesses are kind of focused on cash management, and cash management and cost management to make sure that and I think as a banker as well, the first and easiest way to manage that bottom line in the medium term is to make sure that costs are absolutely effective. So we're seeing decisions being made around people, around premises, around overheads and so forth. And I think there's quite a lot of discussion to that. With regards to and coming back to working capital as well, businesses, once they've kind of reacted and have engaged in some form of debt postponement, they are looking at the wider working capital cycle. So really managing receivables, making sure that they're comfortable with where those receivables are coming from. They're engaging with counterparties that are robust, that they're putting effort and engagement behind those receivables to make sure for timely receipt. We're seeing kind of an increased focus on that. Payables and negotiation with terms of suppliers has been absolutely key as well. And I think as importantly, and we're seeing a lot of this, is stock rationalization. So businesses are really critically reviewing their stock and making sure that where appropriate, they can turn that into cash and improve the liquidity in the business on that front as well. And with regards to those three or four fundamentals, I would absolutely encourage, and we're seeing that our businesses are engaging with the banks and talking through these strategies and asking for that feedback as well. As we go through the recovery as well, we're seeing some recapitalization of businesses. So there has been occasions where businesses have needed to inject their own cash and find equity and so forth to rebalance balance sheets. So there is a move of liquidity coming into businesses on that front. And as we move through the recovery period, and I think for me this is really where this is kind of where we look more long term and strategic. Businesses are looking at new products and are diversifying as well. So some of the examples we've seen are pretty straightforward during the COVID period. But where businesses have got trade licenses that are appropriate, they're kind of moving these to focus on the masks and the gloves and sanitizers and PPE and so forth. And we've seen a lot of clients being successful in winning some of those contracts, accessing their supply chains through China and delivering that here within the region. And that's been a key area as well. And also we're seeing some businesses looking to repurpose their processes and look at using existing systems to develop new products for markets. I think we can see that on the hand sanitizer front, where businesses may have been looking at producing other chemicals and are now seeing a real focus and opportunity there. So these are some kind of quick reactions that we've seen as businesses recover. Now, in terms of this kind of new product diversification, for me, this feeds into the next stage as well, as we look to rebuild. So as we move into the rebuild piece, there's that diversification, as I said, but businesses are increasingly focusing on technology adoption as well. And these are, I've got a few headings here that I'll quickly run through, and these are areas that I'm learning about, and I think we all need to learn about, as there's absolute benefits for all businesses as we see the technology adoption absolutely accelerate. So we're seeing an increase in collaboration software, increased use in cloud services, next level data governance is a key area, prescriptive analysis, AI and the use of these kind of tools, and also automation software as well. So a lot of tech opportunities out there that businesses are looking to take forward. And I think with that as well, there's an increased need for knowledge sharing. So businesses are collaborating a lot more. Sessions like this are more apparent, which is helping for that further sharing of data. And then I think as we move into the rebuild as well, as a leader of a division of an SME bank, an SME division of a bank, and also dealing with our clients, I think there's a real focus on where the winners are going to be and which sectors that we should focus on. So I've talked to the digital piece a little bit, but e-commerce has seen an absolute boost over the last few months, and businesses that are in that space are looking to invest and grow there. The food supply chain, and Henk spoke about this in his piece as well. We're seeing some real opportunity there, and businesses strengthening on that front as well. And linked to that is also a very interesting area in the UAE, and that is the agri-tech market. I've got an interest here, so as well as being head of business banking, I also take a lead on the agri-food, agri-tech front for HSBC in the region, having an agricultural background from the UK. So we've seen some good innovation focused on food security over the last few years, and that has accelerated significantly. And we can see increased reduction in red tape and increased equity available to businesses to help them access that market. So that's key. And Henk also talked about healthcare, and absolutely resonate with that. Businesses all the way through the kind of manufacture of pharmaceuticals and medical consumables, the supply chain training, primary healthcare are key areas too. Education is one that we're seeing significant growth with, and those parents amongst us will have seen our children engage quickly from being class taught to online taught, and some real developments and innovations there, and the education sector is one that we see exciting going forward. The professional services, and the UAE as a hub for professional services is key. And also, in this current market as well, we're seeing a lot of equity and a lot of cash come in as businesses look to find more opportunities. So again, it's just positioning ourselves to focus and support businesses with equity-backed high growth outlook. I think finally, and I think the sector that I finally want to mention, I think we'll link into a Roller's presentation, is any business with a sustainable angle, and this covers all sectors. So the sustainability agenda is key to all stakeholders, and absolutely continues and comes under focus now, whether that's in renewables, energy efficiency, waste management, or anything along social sustainability are key areas that we look to. So with that, hopefully that's my 15 minutes. But I just wanted to give a flavour around the three stages of react, recover, rebuild, and how the SMEs here in the UAE are coping with that. So thank you.
Miles, thank you very much. It was great to as I say, build up with Henk, gallop through so much information in such a short period of time. I'm now going to hand across to Rola. Please, Rola, if I can hand over to you, good self. And please take us through the sustainability agenda. Please, thank you.
Yeah. Thank you, Andrew. Good morning, everyone, and thank you for joining us today. I'm very pleased to be in the company of great institutions here today, together as the leading UK banks, to support you during these unprecedented times. Challenges such as what we're currently confronting are not new to the UAE. Throughout the pandemic, the region has maintained resilience and the support of the government has been key. I would like to touch upon today the changing environments we are living in and how we are becoming more client-centric and sustainable in our day-to-day life. Prior to the COVID pandemic, sustainability in all its manifestations was at the dominant theme across the way we are doing business. The question is whether sustainability will accelerate or diminish as we work towards global economic recovery. So far, the former looks to be the case. During the pandemic, we have seen an outperformance of sustainable assets with companies that best manage their relationships with their stakeholders, showing the greater resilience. Environmental concerns and awareness in the wider community have also stayed strong. When we look at our planet today, the human activity is strongly related to climate change. The lockdown has resulted in heartwarming sightings of blue skies from Beijing to Dubai, and worldwide CO2 emissions are predicted to fall to 8% in 2020. So what does this mean to the business community? We see an accelerating focus on both economic and environmental sustainability. And together, we must manage and protect the planet from climate-related risks. Strengthen our social fabric by thinking locally and globally about ways and means of inclusion. We must drive economic activity and create value and spur economic growth. As my peers on the call, supporting the clients and the community during the pandemic was key, and we started allocating as a bank globally a $1 billion of financing provided at cost to companies providing goods and services to help fight the disease and those looking to switch to these areas. Here in the UAE, we recently closed a transaction under this facility with a large chemical distributor that is looking to increase the quantity of raw materials it will supply to manufacturers of hand sanitizers, ensuring the supply of critical components in the fight against the virus. The UAE government continues to support a move to greener energy with the Energy Strategy 2050, aiming for clean energy to make up 50% of the energy mix by 2050. His Excellency Suhail Al-Mazrou'i, Minister of Energy and Industry, touched on this by saying this would create up to $160 billion of investment opportunities to the country. This diversification effort is clearly shown in ADNOC's recent sale of a 49% stake in its gas pipeline subsidiary to a consortium of international investors where Standard Chartered played a leading role. The move towards a more sustainable future is key agenda for the UAE. And we see this in the Mohammed bin Rashid Al Maktoum Solar Park in Dubai, demonstrates the UAE's ambition in renewable energy. The PPA for Phase 5 was signed by DEWA in April, which will bring the total so far to nearly 3,000 megawatts, well on the way to achieving the Dubai Clean Energy Strategy 2050 goal to produce 75% of Dubai's total power output from clean energy. SC is proud to be involved in this landmark project, particularly Phase 4, which is the largest single-site concentrated solar power project in the world. We continue to advise on use of proceeds-based sustainable finance instruments and are in discussions with many of our clients on how best we put in place a sustainable finance framework and the internal governance needed to access sustainable funds. For our largest corporate clients, sustainable finance continues to be an attractive option, with an opportunity to link financing to their sustainability strategy and broader ambitions, demonstrating their efforts in a clear way to market and other stakeholders. More broadly, we are engaging more than ever with our clients that are in carbon-intensive sectors, such as oil and gas, heavy industry, and transport, helping them to better understand where risks and opportunities lie in the move towards sustainability. Our sustainable deposit product has also continued to be popular for our clients, particularly during the pandemic, as the ability to invest excess liquidity sustainability proved extremely attractive, meaning that we exceeded our target of $1 billion in the first year by taking in more than $2 billion. We recognize that it is crucial for our clients that we support this transition towards a more sustainable future. An important step of that is to support them in difficult times like these, where the strongest relationships will be forged through diversity. It is also essential that we work with them as they transition, which is why we introduced a gradual restriction on clients in the coal sector last year, with the intention that we will cease as a bank will cease to bank as few as possible by helping as many as we can to significantly reduce their dependence on coal. COVID-19 is a circuit breaker that has shown what some of the world's effects of human intervention can look like, but also the potential that reducing our impact, even briefly, can have. We must not obviously let this opportunity go. Thank you.
Thank you very much, Rhoda. Very, very much appreciate that and sort of the insightful information you'll be able to give us there on the whole sort of sustainable finance and actually the sustainable agenda, not just for the UAE, but more broader in the region and globally, and just some of the opportunities that are going to be presented as a result of that. So look, time-wise, we are surprising ourselves here in terms of it's 11:46. At the outset, I said each of the panel members would speak for around about 15 minutes and leaves 10 to 15 minutes at the end. Now for me comes almost like the best part of these panel sessions. We've received a long list of questions from participants in advance of the panel session and during the panel session. And the reason why I think this is the best part is because none of this is scripted now. So I can roll the grenades in each of your direction, and you can respond either confidently, constructively, or be somewhat uncomfortable. So look, first of all, I'm going to hand the first question over to you, Miles, if that's okay. And a question that's come in, I'm not going to name the names of the individuals questioning because some are anonymous and some have, but the first question that's come is, how can SMEs survive post-COVID in the context of the tech revolution and amid limited funding mechanisms? And you touched on this a little bit, when you said about sort of digitalisation or whatever, but just particularly from an SME perspective, because that's a large amount of money, how can they cope with this, revolution?
Yeah, well, thank you, Andrew. And yes, I did touch to this in my presentation, and I think SMEs are maybe not just limited to SMEs, but bankers and advisors and so forth really need to understand and get closer to some of the innovations that are coming and how those can help businesses. So I think we're collaboration software. I think something that that we're all used to now, and I think it's something we're working with quite a lot. But I think when we look at looking at big data, understanding that better, making that work for businesses, for me that's absolutely key. And the use for AI and so forth is really important as well. So I'd advise SMEs to really look at their businesses and speak to others and collaborate with others and speak to advisors around some of the technologies that's there and how that can fit with their business. And I think for me as a banker, if a business comes to me and is adopting these technologies, it shows for me that they're really focused on the future, we're adapting, are evolving, are nimble, they're the kind of businesses that are going to really thrive going forward. So I think it's key that we all have a responsibility to get closer to this and understand it. So I think that's firstly on the technology piece. On the financing piece, absolutely, I think a few points to raise about that. I mentioned at the start of my presentation that I operate kind of in the 30 to 250 million dirham space. So, and that's a conscious decision for us in terms of, we deal with businesses that are, maybe a longer established, have a strong capitalization, have a track record, have asked, and I think from a bank's perspective are, very strong. We're the low risk, low cost providers of finance, and those guys, we can understand, and that's in a market where recourse is a little bit more limited, and there's certain nuances in dealing with SMEs. So I think for businesses that fall within that space, absolutely talk to your bankers, be really clear on the communication, be really transparent in terms of how your business is operating, what your fears are, what your hopes are, and how that's affecting cash flow, and the banks will all absolutely deal with that. But I think if businesses have not quite got the same access to bank debt finance, it's maybe making sure you engage with others in the market as well. So then the UAE, there's good equity out there. There's individuals willing to support. There's opportunities to collaborate in joint ventures. There's crowdfunding sites available. There's mezzanine debt and so forth. So there's a lot of this ecosystem is evolving for SMEs. So I'd really advise that the businesses that aren't able to directly tap into the bank debt piece look at that as well. And from a bank's perspective, we have our role to play within that group. And again, if businesses can come with an element of those to show that kind of engagement, that makes it easy for us to put that lower risk, lower cost debt in place.
That's brilliant. Cheers, Mark. Thank you very much indeed. And as I say, I'm going to confine each question to one panel member, otherwise I'm not going to be able to get through many of the questions. The next question, Rola, actually I'm going to direct towards yourself, if that's okay. So what the question that's come in is, how do you think the experience of COVID will change the way clients do business with banks?
Thank you, Andrew. I think it's obviously, I would say it created an opportunity for us. While you could see that it definitely brought economies down, and the real estate and certain sectors, but at the end of the day, it's also there is an opportunity where everybody fast-tracked digital at least 5 years earlier. Now, I look at the banking sector, banks were always talking about digital, and they were at different stages of their journey. However, immediately the moment we all started working from home, all banks moved to having webinars, having calls, whether it is on BlueJean or Zoom, and to the extent dealing rooms, banks moved dealing rooms from home. So it fast-tracked the digital strategy for most of the banks. Some banks did struggle, but at least now they could see that they will need to invest, because there is only one way forward. From a client angle, clients that have already had their cash management and their trade online, and they were functioning straight through all under automations with their banks, they did not suffer. And they did not have a disruption in their business. It's clients really that were doubting moving to online payments, and they wanted most of their payments to be manual. And these clients we saw have realized that it is very important to move their banking to digital. And that's why during the pandemic, a number of them came to us at Standard Chartered, and we moved them to digital. From a retail perspective, definitely it is digital, and more and more products should be on digital, and you will see less of branches. You don't need as many branches, you will need very few just for service centers, but as much as possible, the customers should do all their banking online, on the apps. So that's how I see it changing, definitely. And obviously travel cost, there will be very less travel. People will do more of webinars and like this, whether it's with clients or events. We will see most of the travel will be done, which is good for the environment and for less CO2 emission.
Thank you, Rhoda. It's interesting you made the point on the branches, because I think if you look at the experience in other locations around the world, the number of branches or high street branches is diminishing rapidly, and it's interesting, as you say, with the acceleration of digitalisation here, you see exactly the same playing out here in the UAE as well, because the proliferation of branches, so it does bring that into question if everybody is migrating to online. So thank you for that. Okay, so I'll go to the next question. On this one, actually, I'm going to ask myself the question, which it is somewhat, but I think I'm as well placed as our panel members, so I'll give them a break from looking to answer this. The question that's come in is there a united front approach or joint effort that the three British banks are doing right now to help clients recover post-COVID? Look, it's a great question. Whoever sent it in, I really appreciate you sending the question in. And the reason why I'm keen to answer it is I actually been working closely with Standard Chartered and HSBC on an effort here. But it's not just been the three banks. Basically, the British Business Group, BBG Dubai, and also BBG Abu Dhabi, so sort of under John Martinson Valerie's chairmanship and Nick Cochran-Dyer's chairmanship in Abu Dhabi. The BBGs pushed themselves forward to be the lead on an initiative that was initiated in partnership with the Ministry of Finance, Department of Economic Development, and also the Chambers of Commerce, which was under the umbrella of what they call a multinational task force. This was initiated probably about 4 weeks ago now, and both John and Nick pushed forward and said, look, as part of this multinational task force, we believe the UK has done a very good job in terms of the stimulus packages it has quickly introduced in the UK across the full spectrum, from retail clients, SMEs, right the way through to large corporates. And we want to take the lead on this and basically work in collaboration with the UK Embassy and also with the UK Department of International Trade, based out here, on pulling together a response we think that will really help, particularly the SME sector. So we basically have had a couple of sort of brainstorming sessions. So it's been the three banks, it's been the UK Embassy and Department of International Trade and the British business groups as well. We pulled together a paper. That paper was submitted, I think, 10 days ago now, which put forward a very small set of proposals where we said, look, this is what has happened in the UK in terms of Receivables. This is what's happening in the UK in terms of the bounce back loans. This is the take-up we've seen of those. This is the feedback we've had from our clients off the back of those. And the success that's being seen as a result of these initiatives is something you desperately need to introduce here, particularly into the SME sector. So we've made that submission. Alongside that, we also made a recommendation that there should be a deferment of VAT payments by local SMEs. And actually deferment should be anything between 6 to 12 months. Because we said, again, that will give SMEs some short-term working capital as we look to come out of this crisis. So in response to that question, I've been here 11 years now. And when there was a financial crisis, it wasn't joined up at all. Actually, it was completely, it felt completely dislocated between the banks, the embassy, DIT, etc. I think on this occasion, through the BBGs, John and Nick have sort of grabbed the torch and not just run with it; they've sprinted with it, and they've brought each of those participants around the table. And I think what we delivered is, I think we were the fastest to deliver recommendations back. And that's because from our membership, our SME membership, we really see there is pain. So to answer that question, yes, we're pushing ahead on that for sure, and we should keep our membership informed as to any progress there. Okay, so as we come to sort of the final 2-3 minutes of our slot, I've got a number of questions in, but I've got one question here which I thought was quite timely and interesting. This one is for yourself, Hank, if you don't mind. So the rise of Joe Biden in the US as now being not just a credible presidential campaign candidate, but could well be a winner of the presidential campaign. And I think JP Morgan, the bank yesterday, were quoted on Wall Street as saying that Wall Street is underestimating Joe Biden as a candidate and need to consider him more seriously. I just wanted your insights from a global macro perspective of, if Joe Biden were to win the US presidential election, what would that mean?
Well, we're, 4 months out or so from the presidential election. You have to say, probably from a top-down view, it still looks a little bit too close to call. But Joe Biden has consistently, we should remember, been ahead of Donald Trump in the national polls for several weeks, although we know that potentially is not the most important factor. The Electoral College is incredibly important, and perhaps we could do a whole session or the next session on the US presidential election, because we know after COVID it's going to be a significant market moving factor. But you look at Odds Checker this morning, which aggregates the odds from bookmakers around the world. Joe Biden is actually the 8-11 favourite with an implied percentage chance of victory of 57.9%. Donald Trump is in second place at 7-4 with an implied percentage chance of 36.4%. Just for your interest, Kanye West is 50-1 with an implied percentage chance. I'm sure investors are fully discounting or fully getting to grips with the policy agenda from Kanye West and family just yet. But certainly Joe Biden is high up on the list for analysts to try to understand exactly what the policy agenda is likely to be. Democrat nominee is known as a moderate who's unlikely to launch a radical agenda. However, he has begun to outline his broad policy stance that would seem to focus on trying to invigorate the middle class, commitments to affordable health care, and the development of workers' rights. He published his economic platform in the report, Save the Middle Class to Save America. This is his flagship publication in terms of the campaign. Within the plan, Biden pledges to raise the top income tax rate back to 39.6% for individuals, corporate tax back to 28%. He's also quoted supporting raising or looking to increase the federal minimum wage to $15 an hour. If you simply take the tax element to that corporate tax rate back to 28%, clearly that would have an impact on markets. You could estimate it could reduce earnings growth for the S&P 500 by somewhere between 10 and 15% in the year that was implemented. And you imagine under the Trump administration, the tax cuts certainly boosted earnings and helped stock market. Trade policy has obviously been a cornerstone of President Trump's time in office, and Biden would probably take the US on a different course. He promised to form a multilateral approach to develop trade policy, particularly when looking at China, rather using unilateral tariffs as President Trump has been doing. So in terms of sectors, healthcare providers, technology, banks, they sit in the middle of the economy. They're sectors that could be affected as we start to see policy implemented. Although we should remember, it's one thing outlining a policy during the course of the campaign. Implementing it when in power is a very different thing, particularly against a challenging backdrop you see the US economy with COVID-19. But I think if elected, Joe Biden likely to place a much greater emphasis on global policy areas, particularly like the climate change, international institutions, and the promotion of shared values. So a different type of president compared to where we've seen President Trump. Still a long way to go, of course, and a lot can change during the course of the campaign, but more than happy to do a session, perhaps more formally, on the US election when we have a little bit more time.
That's brilliant. Cheers, Hank. Thanks very much indeed for that. So look, we're at 12:02 now. I'm going to bring this webinar to a close. I would just like to thank each of the panel members for their time. Today, I think it's been a great session. It's been a great example of collaboration amongst UK businesses, and it's collaboration amongst UK businesses to help UK businesses. And that's really what we've got to do is really work well together. I would like to thank you, the attendees, for joining today. I've been closely watching the attendee numbers to see they haven't been dropping, and we've maintained good attendance. So hopefully we've hit the subject points that you're interested in. But that said, this is for our membership. It's for BBG membership for both Dubai and Abu Dhabi. We would like to know what you think. We'd like to know what worked well, what didn't work well, and also what you want from the BBG as members moving forward. Let us know what your agendas are, and we can then introduce it to our agendas as well. But thank you all very much indeed for your time, and thank you to Standard Chartered as well for hosting this event for us today. And Zaini, you've done a cracking job in terms of putting all this together. So thank you very much indeed. Take care. Thank you all, and goodbye.